Most people, despite their different ages, education levels, and social and financial statuses, always think of a way to make their lives better financially. And one of the things that enable us to do this is to invest our savings or our assets. In this video, we will not suggest investment fields, but we will clarify some important things if you're thinking of investing your money or restructuring your existing investments. First, we must know what investment is. Investment is the allocation of certain resources with the aim of generating income or making a profit in the future. And the idea of investing is not limited to the allocation of financial resources only, rather, it includes all the measures that are taken in order to make a profit in the future. Education is a form of investment. An employee who is trying to obtain a higher education degree than the one he has is considered an investment because the goal is to increase income in the future. But after getting a promotion after studying and increasing the salary, the employee starts saving, and the difference between saving and investing must be well understood. Saving is the accumulation of money for future use, and it is one of the most important tools that help us invest. In order to start investing, we must save part of our current income. Obviously, this means that the expenses should be less than the income. And when we reach the investment stage, the first step we must take is to organize our financial affairs. For example, how much money will I invest? Is it the whole amount that you saved or part of it? You must also know the purpose behind this investment. Another thing to know is the duration of this investment. Is it a short investment, that is, for a period not exceeding 1 year, or is it a medium investment for a period of 3 years, or a long-term investment that exceeds 7 years? And how far can I take the risk? The answer to these questions will clarify your position on investment and the ground on which you stand. As for the second thing, we must know that investments are accompanied by a certain level of risk. Because the investment may not generate any income at all or even loses its value over time. Of course, not all investments are successful, but in most cases, these risks are damped by the returns on that investment. It is, therefore, important to have a balance between the regulation of returns and the level of risk that suits them. For example, investing in bonds has a low level of risk, but also the returns are considered low, unlike investing in the shares of some companies. The potential returns are high, but also the risks. But even in the same investment category, the risks differ from one asset to another. Stocks in the US stock market, for example, are safer than the stock exchange of developing countries. This is due to economic and political uncertainties. That is why when investing in a company's bonds, we should not rely solely on credit ratings. It is true that this is an important factor, but we must seek to examine the company's situation and the future of our investment in it. And here we can ask, why should we risk our savings when we can keep the money? This decision is also risky, especially if the country you live in suffers from inflation, because your savings purchasing power can be reduced. And if your savings are in the bank, you must be able to differentiate between the nominal and the real interest rates in order to know the return of these funds. Suppose the inflation rate is 5% and the interest rate is 8%. This means that the real interest rate is 3%. And mentioning interest in banks, one of the best investments that can be made is to pay off debt. Debts sometimes make us sell assets in order to pay them off. It is possible that it is expected to achieve profits from certain assets after a year, but because of debts we had to sell them before the end of the year. This is what causes confusion in investment plans. There is also an important thing to know, which is diversification in investments. Not all money should be put in one investment category. Therefore, not all investments should be interrelated and move in the same direction of the market. Yet this does not mean the expansion of the investment portfolio to the point of inability to manage it. Another important thing is that a quarterly investment review should be done. This is an assessment of the investment and your personal circumstances and time plans. This is due to the constant change of circumstances and external factors. In the end, this was a quick chat about some simple matters related to investment. Tell us in the comments if you want us to discuss issues related to investment so that we can delve deeper into it, its types, and risks. Stay tuned, and do not forget to subscribe to the channel and activate the bell to follow all of our episodes. Goodbye.